Welcome to This Week's Economy with Dr. Vance Gann. I'm your host, Dr. Vance Gann. This is something new that I'm trying of the first episode of This Week's Economy, where I break down kind of what's going on in the economy, looking at the national level, looking at the globe, what's happening around the world, and happening in the States. It's something I usually put out in my newsletter at vanceginn.substack.com. I'm trying something new. All right, we're all doing something new these days, and so I'm going to really look at providing this through a video form on a podcast. And so I hope that you enjoy it, and we'll share it with your friends and family. You'll be able to find this at vanceginn.com on my website. There you can find kind of all these, whether it be the blog post, it'll be on my blog post at vanceginn.com. You can also find it at my show notes page at vanceginn.substack.com. So a couple different places to go, but I hope that you'll enjoy these as we have some discussions going through the news. Also, if you're not following me on Twitter at Vance Gann, I recommend follow me there as well, as I post a lot about different things that are going on, and I think that you'll appreciate some of those as well. You can find me at other social media sites if you're not into Twitter, Instagram, and others, but something to check out. And I also have my Let People Prosper show, which I'll keep having that coming out on Tuesdays, where I bring in some good guests, talk about what's going on in the economy, other sort of insights from them. But I wanted this one to really just be something short, maybe 10 to 15 minutes of me just going through what's happening in the economy. And to start off, right, this has been a big week because of the Federal Reserve. Federal Reserve is our central bank here in the United States, and they have a target federal funds rate where they use their open market operations of buying and selling Treasury securities, which is government debt. They also have other things on their balance sheet, on their assets, but that's the main one they have is Treasury securities, to try to target what's called the federal funds rate, the overnight lending rate between banks. And so they've been raising this from 8 or 9 times over the last year. About a year ago is at 0%, right? It's up 0%. Now they raised it this week on Wednesday. Today is March 23rd, 2023. So yesterday they raised it up to 4.75 to 5%. That's the range it's in of what's called 25 basis point range there between the two. And what that does is that they pull some of the liquidity out of the economy, pull some of the money out of the economy. They sell some of those Treasury securities off their balance sheet. They bring in more of that cash out of the economy, and that reduces the liquidity, which hopefully will help with the inflationary pressures that are out there, which, by the way, they also help create in the process. And we've seen over the last 3 years, we had the COVID pandemic, the shutdowns that happened, and then the subsequent economic effects of supply restraints that took place, shortages that took place during that period of time, and some other factors. But you also had a massive amount of money that was spent by Congress, whether it be the CARES Act, the American Rescue Plan Act, a number of other bills in the process, but you're talking about $7 to $8 trillion of new spending by the government. Now, I'm not one who believes that government spending increases demand. It is really just redistributing those dollars around because they've got to take from some to give to someone else. But that money does flow into the economy. And remember the rebate checks and everything else that were sent out. And so what that does is increase the national debt. The national debt increased by about $7 trillion as all this was deficit spending. And then in order to continue to have the federal funds rate be so low, which I think they had too low for too long by the Federal Reserve, their target there, they pumped a lot of money in the economy. How did they do that? They bought a lot of those Treasury securities, the vast majority of them that were being issued at the time, put that money into the economy that goes throughout the different sectors, the orders of production. And then what you see is the inflationary pressures. This was going to happen. And we saw the massive amount of inflation, where inflation is still running hot, about 6%, which is the highest in nearly 40 years. So we still got a lot of inflation. So what they're trying to do now, as they've raised their target federal funds rate, pull money out of the economy. And so that's what they've done now to the Fed funds rate of 4.75 to 5%. They've also reduced their balance sheet a little bit, which is really where I think is where they manipulate the economy the most. They need to do that even faster. And so it was about almost $9 trillion. It was $4 trillion before the pandemic. It's about $9 trillion at the peak of April of 2022. They brought it down by about $600 billion as they're continuing to have what's called quantitative tightening, where they're bringing some of that money off their balance sheet. But at the same time, just last week, when we had the Silicon Valley Bank over in California fail, and some other bank, Signature Bank, and some other liquidity issues and credit issues in the banking sector, they pumped another $300 billion in the market. So they basically said, look, we cut 600, now we're going to add $300 billion back. So we're only about $300 billion on net, down from where they were of their peak of 2022. So April 2022. And so I think that there's still a lot of more that needs to be pulled out of the system because there's so much liquidity that's happening. And their 25 basis point increase was less than what the Swiss bank did recently by raising it 50 basis points. And then today, the Bank of England raised their their overnight lending rate between banks by 25 basis points. So we've got continued raising of interest rates across the globe, which is reducing liquidity. And when you have that sort of situation, the artificial boom with so much money being put into the economy, right? We have all these numbers and people dropping out of the labor force as they were getting more in handouts than they could at work. So why would you go back? And massive amounts of deficit spending in the process. And that led to the inflationary pressures of the Fed and other banks printing so much money into the economy that now all that's drying up. So something has to break, and that's where you have the bust. That's why we're seeing the banking sector really start to feel some of these effects now, which will end up also hurting Main Street as well. It's not just Wall Street, but also Main Street, to where I really think we're going to start seeing more job losses across the economy. Look, I think that the economy is pretty weak overall. In 2022, if you look at Q4 2021 to Q4 2022, it was 0.9%, the slowest growth for a year during a quote-unquote recovery that we've had in many decades, right? So this is a very slow economy overall. And when you start having some of these things break, like the banking sector, you're going to see even more contraction, which means businesses across the economy are going to have more uncertainty. Businesses hate certainty. Employers hate uncertainty. And so when you have that amount of uncertainty, I think we'll also start to see this affect the labor market as well, as jobs are lost and the unemployment rate goes up and things of that nature. I also wanted to mention that I had a piece out in the Daily Caller here recently talking about all of this, talking about the debt ceiling fight and how that still needs to be done, where we need to restrain and cut government spending in the process. It also talked about the banking failures that are happening and how all this is all government failure, right? This isn't something to do with the free market capitalist system that's crippled throughout this process. This isn't really capitalism. This is government run amok throughout the process. And we had the boom, right, that we've got to understand and learn from over the last couple of years, which quote unquote boom, right? But now we're seeing the bust. And that's really where the ramifications, the consequences of those actions will come in. So we've seen a lot of volatility in the stock market, which I think we will continue to see. We'll also see the states being influenced by their balance sheets, like their revenue that they're bringing in and what's going on there. But also it might influence a lot of the poverty rates and how many people are on a lot of these programs and social safety nets, which will also influence the states. And so, look, each week I'm going to go through these things. Next week, I'll talk about the state level jobs report, which comes out here soon. We'll dive into that to see where the jobs are being created. A lot of those are in places like Texas and Florida and Tennessee without a state income tax. So we'll have a lot more to talk about each and every week. I hope you'll join me. Please share this with your friends and family. Give us a 5-star rating. Again, this is this week's economy with Dr. Vance Gann. Thank you. Have a prosperous day.